Hello, it's Cynthia Fick, and this is the March 17th stock market update. Well, rather than try to guess or speculate on when the war in Iran may be over, I'm going to remind you of what Financial Life Planners is doing behind the scenes and what we think makes our process work. First thing is, I'm going to rise above some of the headlines and remind you of how we make big picture decisions. And the first one is to focus on what the stock market is showing us it wants to do. Right now, the S&P 500 year to date is down about, let's say, 3% or so. Want to remind you again, bigger picture, that we usually have three 5% corrections every year. We have a 10% correction every once a year also, sometimes 15% every couple of years. So a 3% to 5%, even a 10% pullback is normal to be expected for the stock market. Again, it's two steps forward, half step back. And so we're a very little step back right now. So that's generally remind you of that. The second thing is to look at the longer term picture and remind you of that also. Let me share a screen really quick with you. And that is something I've talked about in the past. There's been three times since the 1930s where the stock market has been in a secular bull. That means a long-term bull up market where the general trend is up. And there's been three times that each of those periods of time have been sandwiched with secular bear markets or stagnation, where basically the stock market can trade down to sideways for an extended period of time. So what are we in right now? My suggestion to you has been for a little while now that we are in a secular bull market. Doesn't mean we're not going to have 20%, 30%, pullbacks in the market, but just that the general trend would be up. So this is a secular long-term bear market where the general trend is down to sideways. From 2000 to 2013 or so, we had a secular bear market. I believe we are in that secular bull, and this is the little blip on the screen that this is right now. Nowhere near at this point breaking that trend. So to become overly concerned about, things like this happening down 3%, 5%, even 10%, takes you out of these long-term upward trends. So the second thing that we're doing behind the scenes is making sure to try to mitigate risk. And I say try because we don't have a crystal ball, but by looking at the market and letting it show us what it wants to do, we can make decisions about maybe getting a little defensive. And getting defensive means we're going to raise some cash, give us a cushion in case any of these downturns becomes a bigger deal, and that we have dry powder, we have money to get back into the market when things show us they want to start going up again. And so that's the third thing. A lot of people can make a decision, knee-jerk reaction, and sell out of the market. Unfortunately, it's not always easy to buy back in. So that's the third thing, making decisions based on what the market is showing us it wants to do when it starts wanting to go up. And new leaders start to pop up and break out into new patterns. We do a lot of technical analysis. That's a general sign that the market wants to go back up again. And that is a time you redeploy the cash. You can't be afraid either to sit on the sidelines. And so these are the tricky. Again, we don't have a crystal ball, can't predict the future, but we can do things based on our technical and fundamental analysis that show us an idea of what the market wants to do and has done in the past. So those are the things that we're looking at right now, and the things we are doing, again, always behind the scenes for you to keep you getting as much of those gains over the long run as possible. So hope you have a great week, and we will talk to you next Tuesday. Bye-bye.